Can you really take risk? Many investors complete a bank, brokerage, fund platform, or online risk questionnaire and then treat the result as a finished investment plan. The page says conservative, balanced, growth, or aggressive, and the investor assumes the asset allocation decision has been made. A questionnaire can be useful. It forces a person to think about loss, volatility, time horizon, and investment experience. But it can also create false precision. It compresses cash flow, emotions, family obligations, upcoming goals, income stability, and market behavior into one neat label. It is not a recommendation to buy, sell, hold, or avoid any product, security, or allocation. The goal is to separate risk tolerance into three layers: risk capacity, risk willingness, and risk time. The first layer is risk capacity. Capacity is not about bravery. It is the objective ability of a household to survive losses without breaking the plan. It depends on income stability, emergency reserves, insurance coverage, debt payments, upcoming large expenses, dependence, job risk, liquidity, and whether two investors can receive the same aggressive questionnaire score and still have very different capacity. One may have stable income, no high interest debt, a strong cash reserve, and money that is not needed for 10 years. Another may have unstable income, a large mortgage, weak emergency savings, and a down payment goal next year. The same market decline is only a paper loss for the first investor, but a forced sale problem for the second. That is why capacity starts with cash flow, not expected return. How much does the household need for basic spending? What happens if income stops for 3 months? What happens if a medical expense arrives, a family member needs support, mortgage rates rise, or a job changes? If the investment account falls 30%, can next year's required spending still be paid without selling at a bad time? These questions are more concrete than asking whether a person can accept short-term losses. The dangerous moment is often not the loss alone. It is the loss combined with a cash flow need. Capacity also depends on the job assigned to the money. Emergency reserves need availability. Money needed within 1 to 3 years needs stability. Retirement money that will not be touched for a decade may have more room for market cycles. If all money sits in one account and one questionnaire score controls everything, the plan can mix incompatible goals. A better structure is to divide money by job, short-term safety, medium-term flexibility, and long-term growth. Each bucket can carry a different risk limit. The questionnaire may describe personality, but it cannot assign every dollar a time. The second layer is risk willingness. Willingness is the emotional and behavioral ability to stay with the plan when markets are bad. Many people feel aggressive when markets are calm. Historical return charts look manageable. A 20% loss looks like an abstract number. But when the account actually falls, the news is negative, friends are panicking, and family members question the strategy. The same person may react differently. Willingness is not what someone says during a calm survey. It is what they can do when losses are real. Questionnaires have trouble measuring willingness because people overestimate themselves in safe conditions. A loss on a screen is not only a number. It can feel like years of work disappearing. It can create doubt, regret, anger, and a desire to regain control. Willingness also changes with experience. After a long bull market, people may become more confident. After a sharp decline, the same person may become extremely conservative. That does not mean the person is irrational. It means recent market experience is shaping emotional tolerance. So willingness needs behavioral evidence. What did you do during the last decline? Did you rebalance according to plan? Or did you stop contributions, chase recent winners, sell after losses, check prices constantly, or lose sleep? Did a friend's profit make you change strategy? Did one bad headline make you want to exit? If the answer is yes, the portfolio should be designed for real behavior, not ideal behavior. A theoretically higher return allocation that cannot be held may produce worse real results than a more moderate allocation that can be followed for years. Rules can protect willingness. Write a rebalancing rule before the decline. Set a review schedule instead of judging a long-term plan every day. Create a drawdown script. If the market falls 10%, 20%, or 30%, what will be reviewed, what will not be touched, and who must agree before changes are made? Write a small investment policy statement with goals, time horizons, target allocation, rebalancing bands, reasons for holding each asset, and conditions that would justify change. The purpose is not to remove emotion. The purpose is to keep emotion from becoming the only decision maker. The third layer is risk time. Time is not simply age, and it is not the phrase long-term investor. It is the calendar attached to each dollar. When will the money actually be needed? Can the deadline move? Could the money be withdrawn earlier because of a job change, family need, tuition payment, home purchase, or retirement income need? Many people say they invest for the long term, but part of the money is actually needed in 2 or 3 years. If that money is invested like a 10-year asset, the plan may fail right before the goal date. Time also matters near retirement. A long life expectancy does not mean every retirement dollar has a long horizon. The next 12 months of spending has a short horizon. The next 5 years of spending has a medium horizon. Money intended for later retirement has a longer horizon. Sequence risk appears when a person must withdraw from a falling portfolio. A decline before or just after retirement can be more damaging than the same decline during early accumulation. The question is not only how long the investor may live. The question is when each spending need arrives. A practical time map can divide goals into 1 year, 1 to 3 years, 3 to 7 years, and 7 years or longer. The closer the money is to use, the more it needs stability and liquidity. The farther away the money is, the more room it may have for growth assets and volatility. This does not mean short-term money can never earn return, and it does not mean long-term money must be all stocks. It means each time bucket needs its own risk language. A single questionnaire label cannot do that work. Together, the 3 layers create a real risk map. Capacity asks, can the household objectively carry the loss? Willingness asks, can the investor behaviorally stay with the plan? Time asks, can the money wait long enough for the risk to make sense? If all 3 are high, the portfolio may be able to carry more growth risk. If capacity is low but willingness is high, the person may want risk that the household cannot afford. Cash reserves, insurance, debt reduction, and goal planning should come first. If capacity is high but willingness is low, the household may be financially able to take risk, but psychologically needs smoother allocation, clearer rules, or smaller steps. If time is short, even an aggressive questionnaire score cannot erase the deadline. To apply this, build a 4-column table. In the first column, write the job of the money: emergency reserve, living expenses, home purchase, education funding, retirement spending, long-term growth, or a flexible goal. In the second column, write capacity, income stability, cash reserve, debt pressure, insurance, and whether the goal can be delayed. In the third column, write willingness, past behavior during losses, sleep quality, family agreement, and decision rules. In the fourth column, write time, earliest use date, and flexibility. Only after that should asset tools be discussed. The order matters. First the job, then the risk, then the tool. Stress testing makes the map honest. Suppose the market falls 20%. Which goal becomes uncomfortable? Suppose it falls 30% and stays down for a year. Can contributions continue? Suppose income disappears for 6 months. Would long-term assets need to be sold? Suppose family members disagree after a decline. Who decides? Suppose a goal date moves earlier. Is there enough low volatility money? The purpose is not to predict the next bear market. It is to identify where the plan breaks. Once the weak point is visible, the repair can be specific: more cash reserve, less leverage, better insurance, lower stock exposure, more diversification, or a longer deadline. Risk questionnaires are still useful, but they should be treated as the beginning of the conversation. A good questionnaire can reveal a person's attitude toward volatility and loss. It can also prevent someone from ignoring risk completely. But it cannot see next year's medical bill, a spouse's comfort level, a mortgage reset, job instability, or the emotional impact of watching a large account decline. Treating the result as the final answer is like looking at one health score without asking about sleep, stress, family history, and daily habits. The score matters, but it is incomplete. There is also an opposite mistake. Some people discover that they dislike losses and then try to eliminate all investment risk. But inflation, low real yields, long retirement periods, medical costs, and purchasing power erosion are also risks. Risk management does not mean avoiding every fluctuation. It means deciding which risks are worth taking, which risks cannot be taken, which risks should be isolated with cash and insurance, and which risks can be carried through diversification and time. A plan with no market volatility may still fail if it cannot support future spending. The final summary is simple. Do not ask only what your questionnaire score says. Ask three deeper questions. First, is my risk capacity strong enough? Income, cash reserves, debt, insurance, and required spending must be able to survive a decline. Second, is my risk willingness real? Past behavior during losses is more important than calm answers in a survey. Third, is my risk time long enough? Each dollar needs a use date, and short-term goals should not be treated like long-term capital. When these three answers are clear, the questionnaire becomes a useful tool. When they are not clear, the score is only a label. Real asset allocation should be built around goals, household cash flow, behavior, time horizon, taxes, and the full financial plan. A practical closing process is to list the jobs of money first, test capacity second, review behavioral evidence third, map time fourth, and choose assets last. If you already have a portfolio, reverse the process. Ask which long-term job each volatile position serves. Ask whether money needed within 3 years is really protected. Ask which expense would be hurt first if markets fell 30%. If those answers are unclear, keep the questionnaire result as a reference, but redraw the plan before chasing return.